All right. Good afternoon, everyone. This is Rich with TMC. Thank you for joining us this afternoon for, I believe, the third installment of the Last Week in Mortgage Today. This is a new 30-minute Zoom episode that we're doing each week, just completely unscripted, off the cuff look at what the hell is going on in the mortgage industry. And each week I'm trying to pick somebody smarter than me to help facilitate the conversation. So this week I am very happy to have my friend and fellow Clevelander, Jodi Hall, the president of Nationwide Mortgage Bankers, with us. Jodi, good to see you.
Good to see you too. I wouldn't say that I'm smarter than you, but we'll see what we come up with. Put our heads together.
The topic better hopefully discussed over a beer sometime soon. We live like 15 minutes away and have
Yeah,
just
for sure.
video chatting since March. So, but I appreciate you taking the time out today.
Absolutely. Glad to be here.
Well, there's no way you can't not lead with the FHFA 50 basis point fee. Really came out of nowhere last week.
Mhm.
MBA didn't even know about it. I guess before we go there, though, give me a little update on what's going on at Nationwide. Busy,
Yeah,
obviously, right?
yeah. So the last week, so we'll keep the theme with what happened in the last week. So Wednesday, very early in the morning, I think that we got up at 4 a.m. and read the release from Inc. 5000, and we were named the #8 fastest growing company in America, the #1 fastest growing mortgage company 2 years in a row. And I promised the founder of the company that I would get that in today. So we rode the high of Wednesday, and we're celebrating all of our successes. And then while we were in the executive management huddle on Thursday morning, we got hit with the news of FHFA. And, it was a mad scramble to get communication out to everyone and make sure everyone understood. And so those were the two biggest things, that happened with Nationwide Mortgage Bankers in the last week. So we can go from there wherever you want to. I was hoping that we had an announcement that FHFA additional 50 basis points was being added, or was being delayed until November the 1st. I haven't heard that. Have you?
No, it's funny. We were talking about it on a team call this morning, and that would seem to make sense. I mean, even if they're not going to, roll back the fee, which
Yeah.
short of something from the presidential office based on political pressure they feel heading into an election, I don't see FHFA reversing
Yeah.
their decision on this. But to delay it would only be sane. I mean, to tell lenders in the middle of August that all loans you delivered to us starting September 1st, which is essentially every loan that's not closed yet,
Yeah.
we're slamming you with the 50 basis point fee. You can't go back to the borrower, from the way I understand it legally, as a change of circumstance. So it's a new add-on. I mean, just talking to some of our members that have GSE pipelines up well over 100 million, if not far more than that,
Mhm.
and the math that they're doing on their head when they hit, it's inconceivable to me.
Right. Yeah. We went into Thursday with about 123 $1 million locked pipeline that didn't have the ability to be delivered and purchased. Just on that was just on our refinance business. So thank goodness it wasn't all loans, but it really is. It's a kick in the pants. Because you are riding a high, right? We're riding a high of the refinance business, and as we talked about earlier, we went from April and May having a 70% decrease in applications because our business is primarily in New York and New Jersey, so we're very hard hit by COVID. So we, come out of that, have been riding the high of the refinance business like everybody else has been, really making a strong comeback. Very excited, about all the accolades that we receive in the industry, to that. But, when you look at it, if you're a well-capitalized company, does it suck really bad? Absolutely. But it's the smaller companies. Hopefully they don't have as great of an impact because they don't have, the locked pipeline. And, it's them, and the really big companies, they probably are making enough money that it stinks, but they can absorb it. But the biggest thing comes to the homeowner, right? So it feels like we are living in a day and age where the rich continue to get richer, and where we want to pump money into the economy, we're taking money out of the pockets of people who pump money into the economy. So the 50 basis points, as bad as it stinks, it's not as bad as the individual home buyers who, could have that additional, savings in their monthly payments, which will equate to billions of dollars that's not being flooded into the economy for, whatever it's going to be going towards mortgage payments, as opposed to, going towards boosting our economy, which is what the big push is. So.
Yeah, one of the really criminally undertold stories of the last several years, just in finance in general, I'd argue, is the amount of money that Fannie and Freddie are making and how that's all just being swept into the treasury coffers. It's why Fannie and Freddie have not been privatized at this point. It is this, massive cash register for the federal government, 4.3 billion with a B dollars in combined profit in Q2, with heavy movements of money to loan loss reserves, with a lot of the pandemic related, missed payments and forbearance in there. So it just, Mark Clyburn just seems to hate mortgage bankers. I think my general sense is like, and I know like the talking points where, oh, well, we need to, insulate ourselves against future losses, all this new business. The fact of the matter is he's clearly aware of I think what's going on in the mortgage industry right now in terms of profits and margins, completely deaf toned to the fact that this is a very, very cyclical industry. Is it our time's good right now? Yes. Remember 2 winters ago when the entire industry thought like the world was ending and their companies were going to go under. So, people that frown on the mortgage industry for making money when it's there to be made, without any consideration given to the other side of that coin, to me is crazy. But I think that's clearly his mindset here. Mortgage bankers are making tons of money. We can just extract $1,400 per loan from their pocket. Yeah. Ultimately, it will come from the borrowers as lenders price it in. And he's not even really thinking about some of the other tentacles to that, it seems like.
I definitely would want to be involved in that change management meeting. Like, does that happen? Like, do they like poll people and say, what effect is this going to have? When we change something within our company, we go through a change management process where we make sure that all departments, that the changes isn't going to negatively impact them. And does Calabria have that? Can you see like a group of, and who's sitting around the table? Because it sure isn't mortgage bankers. Like, it doesn't feel like there's any lender sitting down and saying, hey, this could happen. But you think as big as the agencies are, that there would be that conversation and be like, what is our long-term impact? What's our short-term impact? If the short term, if you're trying to, if your objective is to protect against risk, then why aren't you holding back a certain percentage of your profit to protect that risk? Or saying, hey, let's take 25 basis points loan level pricing adjustment to hedge towards risks. So then you can decide, is it something that you pass on to the customer? Do you split with the customer? Do you take yourself, but do it further down the road? But I would love to see the change management process that they go through before they just make a wide sweeping change like that. And then it's like almost like they want to be a fly on the wall and watch all of us scramble. Like we're all just like pawns in some type of video game to see what our reaction is. And, it's crazy. And I don't really think there's an explanation for it.
I think the decision-making table it's just Calabria at his own table. And because I can tell you right now, like the top people at Fannie, like, we've had some members, I've been reaching out to us all week and, we've sent letters into the agencies, but what I'm candidly telling our members is like Fannie and Freddie don't want this. I think there's some component to, the top people at each of the GSEs, politically probably positioning themselves for whatever lies next. Now, we've been saying that for 10 years. I'd argue the best option for the agencies is to keep them out of how they are right now, and to not do anything drastic like that. But there's probably a little bit of that. But, I'm sure the Fannie and Freddie account reps are taking the brunt of this from lenders across America. But
Yep.
this is not a Fannie or a Freddie decision. This is a Mark Calabria decision, probably nearly unilaterally.
Yep. Yeah. And it's crazy. I can tell you if I did that even with the small size organization that we are, I would be out the door, and it doesn't seem to need to have rational thought process for employment.
You brought up a great point about just how about retaining some earnings. Fannie and Freddie have been making so much money. Anybody can Google it, and see the amount of profit that these companies have generated since conservatorship. People were up in arms when that happened. American taxpayer, we're never going to get paid back. American taxpayer got paid back, plus like hundreds of billions off of that bailout that happened in late 07. And I've been saying this for years. Why, if getting the GSCs out of conservatorship is such a high priority, and they're making billions and billions of dollars every quarter, why are they not retaining some of those earnings as a capital backstop instead of just funneling it all just right into the U.S. Treasury account? It doesn't seem to make any sense.
Yeah. We have a loan loss reserve. We know that you're going to have buybacks, and we protect ourselves. And why it can't just roll uphill, it doesn't make sense.
Yeah, it doesn't seem to make a lot of sense at all. But the fly in the ointment here could be, and I'm still hopeful of some sort of delay at the September 1 date. I think if anything were to happen, it would be this week. They've now, all the different housing agencies and lobbying bodies have all sent their letters in that, this is ridiculous for all the obvious reasons. I think they have all the evidence now. Again, delaying it until just even October 1, November 1 would make the most sense.
Yeah.
Because of volumes and pipelines and, not putting the mortgage lenders on the hook for this fee. But I'm hopeful that something still comes down this week. But
yep. Yep, we definitely, and it made us scramble, and it was a matter of like, what do you do? Are you passing that on to your branches? Are you eating it? And we chose as a company to eat the locks, and for those loans that were locked, we didn't want to pass that on to our branches. If we get into an extension situation, and that is, we are confronted with also dealing with that additional 50 basis points, and we would, deal with it at that time. But it's an interesting situation to be put in and decision to have to make. But we've been making crazy decisions on the fly all of 2020. So I guess August shouldn't be any different.
Add it to the list, right? Yeah. The one fly in the ointment here could be, and why I am still somewhat hopeful of a delay of the September 1 date, is the Trump administration came out on Friday, and it was just some like generic comment from a Trump staffer, but basically, expressing concern at the move. Obviously, that's something that would have had to have at least been looked at by the Trump administration. But has the makings of potentially being a political liability for the president, and something that can really be used against him in the debates. And Biden's new VP pick, Kamala Harris, has been a big advocate of affordable housing initiatives, has really been one of the things she's really attached herself to throughout her political career. And yeah, I mean, this clearly doesn't help the whole housing affordability picture. So maybe we'll see something from the top that, because I think Calabria is getting these letters from like the MBA and looking at Dave Stevens' posts on LinkedIn. I think he's like loving it, like to your point from earlier. I think he may like the visceral reaction from the mortgage industry more than imposing these horrible rules.
Yeah, it is. We are the video game
Yeah, never a dull moment in the mortgage industry. So,
for sure.
so moving on, the other big story really just continues to be how busy things are, and just trying to hire people and get loans closed. And we've talked in the last couple versions of this show just about really the ops staff kind of recruiting wars to the extent that I've never seen them. How does that feel and look from your guys' perspective at Nationwide, and anything you guys are doing to help mitigate or combat that?
I would say we're right there. We recruit in our sleep and interview in our sleep, and have had record level hiring. Our employees are tired. We're all tired. It's just you can't sustain 60, 70 hours a week indefinitely. So we are trying to, add employees. One of the big things is I've always been, of the mindset that you hire and train talent 60 days ahead of growth. We're behind in that hiring just because of what did happen, with being 70% down in applications in end of March and April because of COVID. And we immediately came out, that by the end of May, it was already getting crazy. And then June and July and August have been, record setting applications, and you're combating, hiring with all of everybody else. I set out when I took this position to create a different type of mortgage company where, employees are valued and you live your core values. And that's something that's very easy to say, that you live your core values, but really being able to have employees experience it and them being able to verbalize that to candidates has helped us. Because they see that it's not just talking about what your core values are, but actually living your core values. I try not to talk too much about production, and I do believe that if you build a company on your core values and you provide people the support that they need to grow their careers with you, we all have to work. So you got to like who you work with and what you are building together, and you have to feel like you're contributing to the success of the company, whether you're a loan officer, which a lot of companies will focus purely on sales. We focus on collaboration and all of us bringing it together. So we have had a lot of success of being a different type of mortgage company and getting key hires. I kind of joke with the executives, the business development executives at the company and the chief production officer. And I'm like, you can't hire anyone. Like, you can't bring loan officers. Like, we're running a week for initial underwriting, which is better than a lot, but it's not where I want to be. And I'm not going to use being busy as an excuse not to get faster. But I'm saying you can't hire production right now until I can decrease our turn times. And ways that we're looking at doing that is through robotic process automation, and really segmenting what everyone does. So we are cross-training senior processors into junior underwriting positions where they can underwrite their conventional deals. We're using robotic process automation to click the buttons as much as we can. And I want to be in a position that when interest rates do rise, that I'm not in a layoff situation. So as much of that as we can do through technology and automation so that we can expand and contract with the market, we are going to do that. COVID and the very busy market has pushed a lot of our initiatives into fast forward to try to get them across the finish line so we can drop those turn times. And then, once we get through the proof of concept and we are able to get to 48 hours in initial underwrite and 24 hours for everything else, then we'll keep recruiting towards our core values and hiring people we want to work with and people that we like working with.
You hit on a couple things there that I'd like to follow up on. One is just like the general cyclical nature of the mortgage industry. It's so busy right now. Most of the economists have revised their origination projections for this year, like 3.4 trillion. It's going to be the biggest year for originations, I think, since '03, which was one of those insane, like countrywide fast and easy fueled years. Um, but that's a huge number. I think the original projections for this year were like 2.1, 2.2, somewhere around where last year came in. Again, most of the economists are projecting next year to still be a really good year historically, 2.3, 2.4, 2.5 trillion, depending on who you look at. But where I'm going with all this is just the dynamic. Right now, everybody is just hiring, paying. 9 months ago, it was like the human loan processor will be eradicated forever. And now
Yeah.
it's like processors are making like 70,000 and underwriters are making over 100K in the Midwest. And,
Yep.
but once, I mean, this refi train runs its course, who knows what the hell is going to be going on with the purchase market related to the pandemic and other things going on. Like, I mean, I've just seen this happen so many times before my last 17, 18 years in the industry. Like people are just bulking up now
Yep.
as if we're going to continue to run at this insane clip. Because I guess you kind of have to, but
Yep.
well, the other side, Faith Howard Mooney, our VP member engagement, she was talking to one of our COOs this morning of one of our larger IMB members, and he was talking about getting a group of TMC members to talk about this dynamic, some kind of working group, like how to hire intelligently, how to set yourself up for success, some of the things you touched on there, because we're going to get to at some point, and there's going to be so much excess labor
Yep.
in the mortgage market.
Yep. Yeah. And we're all talking, I mean, everybody's talking about how can we hire interns and college graduates and train them into the mortgage industry. So not only are we going to have the existing people with mortgage experience, we're going to have a whole new group of that have just entered into the mortgage market for employment. And it is, it I don't, that's why I think that if you can expand and contract with technology, because think about it. So if you use robotic process automation and you can do 75% of your conventional underwrites, and then because right now it's all conventional, we were 60% government, 40% conventional. We were as high as 87% purchase business. Now we're 65% refinance business. But if you can use robotic process automation on your conventional refinance transactions and some of the process for your conventional purchase business, you're taking a big bulk of that. But that technology can expand and contract. It can work over the weekends, it can work overnight. And then when business slows, then you are typically, what will happen is your government business will go up, your purchase business will go up. Those are areas where we need to have the expertise of an underwriter or senior processor. And we should be able to ebb and flow with the bulks in the business. And then let's train people into the industry to be loan officers. So then, you focus on sales and bringing in production so that you can, today you should be training for winter, right? You should be training up loan officers because it's going to take them. So if you want to use new college grads, let's get them into loan officer positions and teach them to sell. And then the problem with it is when you have all of your managers who have their sleeves rolled up and they're disclosing loans and they're opening loans and processing loans. And I even underwrote a loan in the last couple of weeks, which I haven't done for a very long time. I didn't actually do it in the system because I think that our head of credit risk probably would have had my access revoked indefinitely. So I wrote it and put all the comments in. And I was like, I think this is what you could condition for. But they're so busy doing that, they don't have time to train people up. So, that it's a challenge, but we need people that can help today, that can give us lift today. So that requires experience, or it requires knowing how to program a bot to run AUS findings and read it.
We got about 5 minutes left, and I wanted to spend the rest of the time just talking about technology. You mentioned one piece of emerging technology, robotic process automation. There are some other emerging tech initiatives and products that are coming. They're on their way here. Advanced document recognition and just, I guess potentially exasperating the flood of labor and new people into the mortgage market is the fact that the wave of technology that's still not here mainstream, really a lot of it serves to, you know, streamline workforces. So every, CEO of an IMB or head of mortgage lending for a bank or a credit union I've talked to these last few months has said we have not even had a chance to, if you go back to March 1, I think new tech, emerging tech was a top three thing for the vast majority of CEOs out there. And they have not even had a chance to assess it, to look at it, to, of course, implement anything. You guys were lucky to have some of that in place already, but how do you see that whole dynamic playing out? The fact that there is a lot of new technology coming, that it's kind of been on pause for 6 months, and
Yep.
what that maybe stands to do to the labor issue we were talking about more broadly.
Yeah, I don't think people are going to have the time to look at it unless they have teams dedicated to vetting technology. One of the topics that you sent me was the acquisitions that have happened related to tech companies, Ellie Mae's purchase. And this is what I want. And I've talked about this even before I became president of Nationwide Mortgage Bankers. And what I want is one of these software tech companies to be the end all be all. So don't make me as the decision maker of a mortgage company go out and have to vet a point of sale and vet an LOS and vet an appraisal management system and vet a credit provider and vet, like, you have all of these pieces that you have to figure out from a technology perspective how to tie them together to make them work as if it's one easy flowing system. It's insane. Like, when you talk about, is this an open API that I can, intertwine the point of sale with the LOS? If so much money is going to be put towards technology, I want the company that shows up on my doorstep and says, listen, you don't have to vet any of this anymore. Your point of sale, the borrower is going to be able to do their application. When they do their application, they're going to get a pre-approval. It's going to tell them what their pricing is. They're going to run findings on their own. They're going to pull their own credit. And we're going to deliver a loan, which is in the same system, to your fulfillment team, which is the LOS. And through that, then we've already vetted what is the highest technology appraisal management software that is able to connect where the borrower can even go through and they can order their own appraisal. And then it goes all the way through the process. So the loan officer's in the same app, the borrower's in the same app, all the way through closing. I don't have to pick an e-closing platform. It's all part of the same system. And that platform also is integrated with the investors and the agencies to be able to deliver. And you have one-stop shop. When you add up all of the little different incremental pieces that we pay for in the mortgage company, in a mortgage life cycle, from LOS fee, point of sale fee, credit fee, flood fee, if someone can make that happen, that's who's going to have 100% market share. Because we don't have time in this day and age, we don't have time to vet. I mean, we vetted 3 different AI companies, and that was like an almost a year process to find someone that we wanted to be in a relationship with and work with to try to bring some of this to fruition. We don't have that kind of time. And I think that the company that solves it first is going to have the biggest market share. And I don't know what the market looks like in, for LOS 5 years from now, but that's what I want. I don't want to have to hire, 30 developers to be able to tie systems together. I just want a system that's already tied together, and would definitely create efficiency within the process. And then you hire people who can manage that process. And as much, artificial intelligence and robotic process automation that can be within that system will win.
I'd argue the mortgage industry, of any industry, the participants historically have not played well together. Like it has been a very, a very dog eat dog. We tried to roll out an initiative, like it was in like the same vein of what you were just talking about, called like the Digital Mortgage Alliance, like 3 or 4 years ago. Essentially, we're trying just to get all the TMC preferred partners to agree to not charge each other integration fees, and to prioritize our members and each other when it came to integrations and implementations and the costs associated with them. And there were certainly companies that wanted to do it and were bought in, but it was it was a challenge. And it's going to be very interesting to see how things play out with Ellie Mae now reacquired, Black Knight making a lot of really strategic acquisitions. I think Black Knight's trying to do what you kind of just said. They're trying to purchase who they view is the top provider in spaces that would complete the puzzle, as opposed to building it themselves, which Ellie's done a little bit more of. So, and then I've talked to other people too that I respect their opinion a lot, that feel like you look 4 or 5 years from now, you might not even need a traditional loan origination system. If you have a compliance engine and, a document portal and if you a CRM and a POS and, you can meld those things together without the crazy cost of a operating system to piece it all together. But it'll be interesting to see how it plays out. So
For sure, for sure.
awesome. Well, Jodi, thank you very much. Always enjoy the conversation.
Yes, thank you.
Yeah, and congrats on the Inc. 500 award.
All
That's
right, I
awesome.
appreciate that.
Yeah, and here's to cold beverages in person somewhere soon here.
In the not too distant future, let's set it up for
Yeah,
September.
absolutely, for sure. So, to everybody that joined on, thank you very much. We'll be distributing the copy of this video to the whole network and to all the registered attendees, and be back at the same place, same time next week for the Last Week in Mortgage Today. Thank you, Jodi. Take care.